dollar cost averaging might look smart on paper, but here's the dirty little secret that Wall Street does not want you to see. All right, so if you're not familiar with what dollar cost averaging is, it's something that financial advisors love. They will teach it to you over and over again. Even the financial experts will say it's like the best thing ever. They almost become orgasmic with it. Can I even say orgasmic on this channel? I don't know. But they love it. They love dollar cost averaging, don't they? Because why? Because they're saying, hey, if the market goes down, you should buy more. But what you also hear financial advisors say is the market goes up, buy more, right? They're saying, you don't know what the market's going to do. It's going to go up. It's going to go down. You have no clue. So what you're going to do is just keep buying throughout that. It goes up and down. Just keep buying, because if it goes down, you're buying it on sale. And so they're saying, like, instead of just throwing in money all at once, just start buying all throughout in regular periods. I don't care if it's like $100 a month, $1,000 a month, just keep buying all the way. And eventually you'll make more money because you dollar cost averaged. And I'll tell you, I've even had people come on our channel and even make comments saying dollar cost averaging is the best thing ever. Everybody should do it. And I'm not opposed to the actual premise behind it, but I am opposed to the strategy, because that strategy, unfortunately, does not work. And here's why. Okay, so this is a paper I actually used to teach as a financial advisor. I actually dug this thing out of my old files. This thing is almost 25 years old, okay? I love the fact that they showed dollar cost averaging. Now, if you see here, they'll give you 3 examples, right? And this one just says that you're taking $200 a month. This was, of course, back in the early 2000s. Nowadays, it'd be at least $500 a month they'd be showing. But $200 a month, and it'd say, if you looked at it here, like $10 a share, you know, back then, right? $200 a month would buy, of course, I'm doing the math here, 20 shares, right? And so it keeps buying, but then it goes up. And it's like, oh, it's $12 a share. Well, now that $200 buys less shares because it's $12 a share. Now you're buying like, you know, instead of 20, you're buying like 16 shares. And it keeps going up. Eventually it's $20 where you only buy 10 shares of the stock. So say, even though it's worth $20, because you keep buying it, you bought 85 shares, average price, they say 15 bucks. So basically you're at $1,700, all those shares you bought, because 85 times 20 is $1,700. So they're saying, hey, not bad. For 6 months, you put in, you know, $200 a month, that's $1,200, and now it's worth $1,700. Well, also the stock doubled. So think of this, all right? If you turn your brain on, you'll say, wait a minute, what if I had just taken, instead of $200 a month for 6 months, what if I took the $1,200, put it in at 10, well, it'd be worth $2,400, not $1,700, right? But they didn't say that. Look at this other one. Now they'll show you this. Now, this, again, although numbers are true, you got to take what Ben Stein's father taught him. When Ben Stein told his father, he's like, Dad, but figures don't lie. He's like, son, figures don't lie, but liars figure. Watch. So here's one where the stock goes down, cuts in half, and then comes back up to where it started, right? So again, you buy it all the way down, you buy it on sale, right? This is what they tell you, buy on sale, and then you buy it on the way back up, and look, you still made $1,700, even though the price is half, because you bought it for half price for a few months, or as it was going down and back up, you still bought more shares, like double the shares, and that's why you have the same money. So people, they tell you, hey, even if the market goes down, comes back up, you made the same as if the market doubled. And then they show you this. They showed the Great Depression chart, right? Where it goes from $10 a share down to 1, and for a couple months you buy it at $1 a share, so you buy like 200 shares, then it pops up to $4. So it doesn't even recover all the way. They'll say, well, look, because you bought 535 shares at $4, it's now worth $2,100. So they'll show you this, and they'll say, look, you want to buy it on the way down. You're buying it on sale. Just like you go to the store, you buy on sale. And this sounds logical, doesn't it? But imagine this. What if, again, you had that $200 a month, that $1,200, you said, wait a minute, what if I bought it, you know, towards the bottom? Maybe you even didn't buy at the bottom at $1. You bought it at $5, right? Or maybe even waited till it hit $4. Let's just say you bought it at $4. Well, that $1,200 buying at $4, guess what? That $1,200 times 4 is $4,800. You would have more than double than if you just bought it all the way down. And this is my point. The best time to buy is at the bottom, obviously. But they will convince you, they'll tell you, well, you don't know where the bottom is. Well, let's look at the market right now. The S&P 500, you look at the Buffett indicator, which talks about the valuation of stocks and where they should be compared to the actual price. Right now, the price is more than 200% higher than it should be. So if you're thinking that 100% is where it should be, it's over double that price right now. That means the S&P 500, which is well over 6,000 as of the late summer of 2025, guess what? It should be down below 3,000 on the index. That means all of us should be at half price. So people say, like, Chris, should we buy in stocks right now? Should we keep buying along the way? I'm like, no. If anything, accumulate more money now, save up the money, and then after the market crashes and nobody wants to be in the market, right? Because there's blood in the streets, as they say. After the market crashes, that's the time you would actually buy in the stock market. So I tell people, like, I've got $0 in the stock market. Even Warren Buffett, who has invested in the stock market, the guy's almost a freaking 100 years old, right? The guy's been literally investing since before most of us were born. This guy was investing in the 1940s, guys, okay? And so he's been investing in the 1940s. He now has 30% of his money just sitting in stocks on the sidelines. He's liquidated Apple shares. He's liquidated Bank of America, which, by the way, he bought Bank of America after the last global financial crisis, when Bank of America needed bailout money to stay alive. He bought it for a deep, deep discount. And guess what he's doing now? Selling it, right? And what's he doing with Apple after he bought it at a discount? Selling it. He's selling it off and getting his cash ready for a buying opportunity. Now, I'm not here to tell you when's the right time to buy, but usually the right time to buy is when nobody likes stocks anymore. Right now, everybody loves stocks, and that's when you know it's the worst time to get in. The best time to always get in is when nobody wants it. That's when you want to get in. That's why people say, oh, real estate's overvalued. No, it's not, because people are still scared to death that real estate's going to go down. And that's how you know it won't go down, because when everybody expects it to go down, it doesn't. With stocks, that's a different story, right? Again, it's been going up, and now everybody, even people on TikTok and Instagram, are telling you it's just going to keep going up. It's going to go to the moon. It always goes up. Well, what if it doesn't? And again, if a financial advisor is smart, when they tell you, listen, it's been going up way too hot for way too long, stop buying. Wait till there's a crash, buy more, buy it on sale. Dollar cost average. No, don't dollar cost average, buy low, sell high. That's what you should be doing. That's where you could take this chart and shove it up their little rear ends and say, no, I'm actually gonna do this smarter by doing this way, where I'm actually investing like an investor and not like some ignorant, blind fool who's just following the other blind fools that don't know what they're doing, called financial advisors. That's what you want to avoid. At the end of the day, dollar cost averaging by itself will not make you free. Yes, you can make lots of money, but at the end of the day, it's about passive income is what makes you free. And we talk about that often on this channel. So if you haven't subscribed to the channel, do so today. But if you want to really know more about how you can do something better than dollar cost averaging, how you can actually make more that generates real passive income, go visit our website, moneyripples.com/consulting to find out more today.